can't be sure that we are measuring the right stuff to build our factor portfolios, concentration is dangerous. So at a high level, I agree. And then so what I wrote here is some notes. So for me, when I think about investing, it really is more art than science. And quant to me is a tool to minimize my monkey brain from interfering with the concept after the fact, right? But I don't, so I'm a huge believer that strategies and systems should be designed by me thinking way too hard about this, really engaged in thinking through financial economics, incentives, and psychology of people, and not just doing the pure quant route. Whereas if you're just a pure quant, and I used to hang out with a lot of these people in the PhD lab at Chicago, I'd ask them, like, because I used to trade stocks and be like a stock alcoholic, 100% of them had never even traded a stock before besides me. So, I remember vividly sitting in Chicago there, and like a bunch of famous people now, because it's been, 20 years, they're all like fancy folks at the shops. But back in the day, it was like Daytech and TD Ameritrade. It was like the broker platforms. Yep. And I used to trade stocks all day in there. And like none of them even knew what like a limit order was. They'd never actually interfaced with marketplace. And so when you're just pure quant, pure data, you're always going to end up with a solution that's going to have 500 factors, super optimized on Sharpe ratio, very complex. No one's going to understand really what's going on. And it's going to be awesome. It's going to like impress all your peers when you publish it in the peer-reviewed journals, blah, blah, blah. But unfortunately, when we look at the out-of-sample performance of what they built, and we compare it back to brain-dead, simple concept idea, time and time again, we always see that you got to the exact same place with 10 times the complexity. And the best example of that is old school Ben Graham, right? So Ben Graham, and I wrote about this in one of our earlier books, but he has this article he wrote in the FAJ, or it actually was a medical journal, where he outlines the most basic deep value strategy ever. It's like, hey, buy 20 stocks that have the cheapest PE and make sure their debt to equity ratios are under 50% or something. And then he has this crazy back test from like the 20s up to 1972, and it makes 15% annualized return, and the volatility's jaw dropping, like 25% or 20%. And then so what we said is like, well, let's just do that simple brain dead strategy, buy concentrated low PE with some stupid like quality check, like debt to equity ratio, and do 72 to 2013. And you literally get the exact same result. 15% annualized return and the most insane jaw-dropping volatility and relative performance you've ever seen in your life. And all this is basically one signal. Buy, top decile cheap. And it works. In sample, out of sample. We don't got to argue about when book to market was measured. It works. And you see this in all strategies. Take the most complex thing, and we used to do this all the time, keep making things more complex. And then when you just compare them in a genuine comparison to like something that's pretty simple and captures the same ideas, you end up in the exact same place. And so it's not really about optimizing on the exact measure or the exact detail of like do we want to do a composite or we want to do this or that. It's really about what signals are you using. And hold on a second. Sorry, I got people bugging me right now for some reason. It's really about thinking through what are your signals currently and what are they trying to do. And so in the end, what we try to do, and I'm not saying this is the right way, is we believe that characteristics proxy in the end for risk and or mispricing. And I know this is a DFA-centric crowd, but more and more the evidence, I think, is becoming clear. And I don't know if you guys have read the Robeco long-term factor investing study, where they actually at the end, they go all the way back to 1800, do this massive data collection for out of sample to try to understand, the reality of factors. what they conclude is that risk is actually not, you can't find any evidence that risk drives factors. In the end, it's all really seems to be mispricing. So, and that's just something to be aware of. Like, I've always been trained that it's all risk and mispricing, and I've always thought it was both, but more and more, I think it is reflective of mispricing.
We just had a comment from Alex who said we are a factor centered crowd only, not a dimensional centric crowd. So,
yeah, okay, cool. Yeah, I just want to make sure that I just don't want to offend anybody, with saying something and getting yelled at. But and I'm just highlighting that I am a believer also in the risk thing, because that was my training, and I now also believe in mispricing. But interesting enough, more and more evidence seems to be coming out when you look at like the long tail studies that are genuinely out of sample, that it's hard to say that risk really drives factor premiums, frankly. It does seem to be mispricing. And I was just highlighting that when we go into this discussion about, well, how do you measure this or that, the other thing, it really boils down to me like the art versus the science of it. And for value, which I inherently believe is just a fear trade, you're exploiting mispricing associated with bad sentiment, like baby got thrown out with the bathwater problems. Whatever you use to measure that, and I think that measurement needs to measure some fundamental to some price, because market prices relative to some fundamental generally tell what the market thinks about the fear gauge on this particular security, will work. And we can argue forever about the best way to do that, and we probably will. And then momentum, in my opinion, is a greed trade in the end, right? It's also based on how do I exploit people that love to performance chase and believe in rainbows, and that's fine, but we just want to front run that. So whatever measurement you want to use that you believe helps proxy for things that look like shiny objects and people want to play with even further in the future, that's a great measurement. And the specifics of those measurements, I'm not so sure matter that much. Like, you want to do 12-month momentum, you want to do 11.5-month momentum, you want to do 9-month momentum, whatever, as long as it's in the ballpark of being capturing the open secrets, which is, hey, intermediate term momentum works, they're all going to be in the same spot. What I wouldn't recommend, though, is, for example, in momentum, we're going to look at 2-month momentum, and that we're going to equal weight every momentum measure from 1 month to 30 month, because maybe it's the case that different momentum measures, like in the short run momentum or like the 5-year momentum, aren't capturing like the fact that we want to find a momentum measure where when Dum pulls up their Schwab account and they look at the 1-year chart and the thing is ripping and it looks like a straight line, that's probably going to capture the type of crazy stocks that we want to focus on if we want to front run idiots. Whereas maybe the 5-year chart is less important, right? So whatever your measure, as long as it's grounded in what you believe you're trying to exploit, whether it's risk or mispricing or some combination of both, that's what's most important in my mind, and less about the nuanced specifics of how you go about it, if that makes any sense.
Totally makes sense.
We can argue about minutia till the cats come home.
Do you think that what seems to be an increase in individual investors doing crazy stuff, like the Schwab guy you just mentioned, trading on the straight line?
Yeah.
If that increases based on what you were just talking about, do you think that means we would expect higher factor premiums?
I do. I do think that the more crazies and the more fear and greed in the marketplace, obviously at the margin, the better for people like us who are using systematic approaches to basically exploit fear and greed. So I'm pretty bullish as more retail and emotionally driven investors obviously enter the marketplace. But yeah, so for sure. But that can wane over time, right? Like like someone told me a great analogy recently. You enter markets where people value things like Rembrandt paintings, and then sometimes you're in markets where people actually think about fundamentals and cash flows. Clearly, we're in a Rembrandt market right now where it's art. Like, you value it because you like Tesla and what they do and like their emotions or whatever. Like, you don't actually look at the fundamentals. And I think actually this is a Charlie Munger analogy here. And so I think factors probably work a lot better when you're in Rembrandt markets as opposed to like cash flow markets, just because again they're meant to exploit fear and greed in the end. And I'm starting to believe that more and more versus factors are there to capture risk premia. I just the evidence doesn't seem to back that as much as it used to.
So Wes, there's a comment there saying, does that mean
Yeah.
you think markets are inefficient?
I do. I think they're super competitive, i.e., if we define efficient as in the formal way that prices equal the DCF of all future cash flows, i.e., they're actually correct. I think that is definitely false. And all you have to do is look at GameStop or AMC or pretty much anything right now. Like no one can convince me with a straight face that those reflect market efficiency in the sense that prices equal fundamental value. But just because prices aren't efficient, I want to make sure it's clear that I don't think that money grows on in trees in the market, right? Just because it's inefficient doesn't mean it's easy to beat the market. Just like it's not easy to take advantage of GameStop idiots and to go try to short the stock because you want to take a fundamental view. Because you can obviously die and go bankrupt trying to do that. And herein lies why I think fundamentally, even though everyone knows about factors and any idiot can go do a momentum strategy or value strategy on their own, they're always going to work if you believe in fear and greed and you believe that it's costly to arbitrage idiots, which I fundamentally do believe. And I think that keeps getting reemphasized as we go through different market cycles and experience things like we are now. I just think it's evergreen, but not easy. So, yeah, long story short, I don't think markets are efficient, but I do think they're competitive, if that makes any sense.
That's a great statement.
It's called arbitrage idiots.
Yeah.
That might be the title of this whole presentation.
Yeah, arbitrage idiots, but just be warned that idiots can cost you a lot of pain and anguish. So it's a fairly compensated arbitrage trade. Just as you guys know, being a value investor is kind of a long-term arbitrage in some sense because you're exploiting people that just, bomb out things that fundamentally are probably worth more. But as you know, you have to endure 10 years of looking like an idiot and having everyone tell you you're stupid, only until like the last, 6 months to be, I guess, almost kind of proven like, hey, it pays to stay, but it's very difficult. Anyways, so yeah, we can have those conversations as we go, but I'll keep powering through here.